All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office. For the past 44 years, you'll remember it's been our mission to deliver clarity and confidence to help secure your financial future. Wow, it's the first episode of 2026, episode 210, if you can believe it. And I just want to wish you and your family a very happy new year. Unbelievable. 2025 just seemed to fly by, and here we are, 2026. S&P is close to a all-time high. We finished out last year, 2025, at 6845, if you can believe that, on the S&P 500. And it seems easy now. I was actually at a New Year's Eve party last night. Somebody came up to me and said, "What do you do for a living?" And I said, "We're in wealth management." He said, "Wow, must have been an easy year being in wealth management with the market up 17%. And I said, "Well, it was, but you have to remember it wasn't a straight line up to the right." A lot of people look at the market today and they say it was easy to be in the S&P 500, and they forget Liberation Day back in April when everybody was bulled up going into 2025. All the Wall Street pundits and strategists said that we were going to hit all-time record highs in 25. At the first sign of danger, when we had Liberation Day in April and tariffs came out, everyone panicked. And we at Stenger Family Office did not. Despite the market being down 19%, we reiterated our 67.20 price target for the end of 2025 back in April. And so when people say, "Oh, it must have been easy to stay on your plan or be in the market or get a 17% return on the S&P 500 this past year," I just say it wasn't. It wasn't that easy, and it's never that easy. If it were that easy, everybody would just buy an S&P 500 fund, and that'd be the end of it. But it's not that simple. The difference has been for investors to be coached on a long-term goals-based plan, and all the data shows this. In fact, Vanguard did a survey years ago, and they said the long-term average on the S&P has been about 10% a year for the past 200 years. Dr. Siegel studied that as well. But the average investor has only gotten 5.5% per year. What makes up that gap? What's that difference accounted for? Well, it's in your planning, it's in the coaching, it's finding a good fiduciary financial advisor to keep you on track when the going gets tough. And I would argue that the going is going to get tough in 2026. Again, I have predicted that we will have about a 15% pullback at some point in the year. Could be lower, could be higher, and just be prepared for that. Just like 2025, where we had our 19% correction, I think 2026, we're going to have a substantial pullback again, not atypical after we've had three back-to-back melt your face off years. And that's exactly what we had. 2023 was a monster year, 24 was a monster year, 25, of course, was a great year. And so 2026, we could hand some back. We're going into the midterm election cycle, and that's always a little volatile. And so we'll see what happens. But let not your heart be troubled. Do not panic. Just remember this show. Remember last episode with the Market Outlook show. And just remember that we told you it's coming. We're not going to be surprised by this. So send me as many texts as you want. Send me emails and reach out and say, "Nick, what's going on?" And I'm just going to remind you, we prepared you for this, and we have prepared your financial plan for this. That's the most important part, that you would be on a goals-based financial plan. When you meet Stenger Family Office clients and the market's down and you ask them, "Why aren't you worried about your portfolio? Why aren't you worried about the markets right now?" They ought to tell you, and I think a lot of them do tell you, "I'm not worried. I'm on a goals-based plan. I knew this was coming." And by the way, if you're in your 50s or your 60s, and you're certainly your 40s and 30s, but if you're still working and you've got a 5+ year time horizon until retirement, you should welcome these corrections with open arms. Why? Because it's a buying opportunity for the future. Now, just so you know, the chef is eating his own cooking, so to speak. And at Stenger Family Office, with my own personal 401k, I set my contribution rate yesterday for 2026 to 82% to try and get that thing maxed out as quickly as possible this year, because I think the market in the long run is going to do great. So I want to get those dollars into the plan ahead of time. That may be a good idea for you too, maybe not. You have to look at your cash flows and make sure it works. But I am doing the same thing that I am telling you to do. I'm getting money to work right now. I put cash to work last week. I put cash to work at S&P 6,900, 6,800, 6,850, and I think you should be too, because despite a correction, despite a pullback, It's impossible to time the market. You just can't do it. Everyone that has tried to time the market may be right getting out, but they have to be right twice and they have to get back in. And it just doesn't work like that. Nobody's been right twice consistently. And if they had been, you would know a lot of people who have turned a couple $1,000s into multi-millions of dollars. And that's just not the case. Instead, you know a lot of people who have just stayed consistent and slow and steady over time and stayed on their plan. And now they're millionaires next door. They have a few $1,000,000. And how did they do it? They just went to work every day for 20 or 30 or 40 years. They kept socking money away in their plan. And that's how you get rich in the stock market. You do it slowly over time. There are no quick and easy fixes in the stock market. And if you hear of something like that, you should not walk out of the room. You should run out of the room. And it's just not reality. So anybody who has this market timing strategy for you, stay away. The other thing that I encourage you to watch out for in 2025 was all these people selling annuities or buffered products or all these insurance schemes that seem to promise upside with limited downside. And again, when you hear stories like that, when you hear, oh yeah, you can still participate in the market upside and not have any of the downside or have very little of the downside, there's always a cost to that. That's insurance. So insurance, you need to buy insurance for risk management. We've always talked about being proper risk management in your financial plan and your personal life and all the rest of it. But when you start doing that on a broad scale with your financial investments, your portfolio, with your financial plan, you're starting to enter dangerous territory. So just be careful of the people you're listening to, because fear sells a lot better than our pitch, which is just stay optimistic and stay on your plan and follow the data. And I'll tell you when I think the market's overvalued. I've done that in the past. I've told you when I think earnings haven't really caught up with stock prices. And I told you that in 2022. And we didn't nail the timing exactly because we're not market timers. But I told you, just watch out. Market's a little pricey right now. And sure enough, 2022, we had a pullback. But we're not anywhere close, even to the valuations that we had after COVID and the valuations we had at the end of 2021 when the Fed had cut rates way down. So we will tell you what's coming, what we think is coming. We'll tell you if we think stocks are overvalued. And so today, I do not think that stocks are radically overpriced. Instead, I think you're going to see us climb a wall of worry in 2026. And the best bet is just to stay in your plan, just like you always have, despite any corrections and pullbacks that come up. Now, let's get into a recap of 2025 as we go here. I want to tell you a couple things about 2026 as well, but just a quick recap here on 2025. The S&P 500 finished up 17% for the year. The top 50, which is what we buy for our clients at Stenger Family Office, was up 20%. The Mag 7 still led the pack, was up 23%. And then you had the smaller stocks like mid caps and small caps actually trail the S&P 500 heavily, just like we predicted. Mid caps were only up 8.5%, which I say only, not a bad return, 8.5%. Small caps are up about 7%. Now, what gets interesting is when we get into international markets, Europe was up 36% last year in 2025. China was up 32%. Remember, I told you we don't love international markets. So zoom out from the past couple, just last year, and let's go to the past few years, to the past 5. So yes, Europe was up 36% in 2025. However, it's only up 60% the past 5 years versus the S&P 500, which is actually double, up 120%. China was up 32%, like I mentioned last year. However, it's still down, if you can believe that, 19% the past 5 years. So we always tell you at Stenger Family Office, when in doubt, zoom out. It's not that you're not going to have a pop once in a while in international. It's impossible, again, to try and time that and trade it and figure out when the currency is going to work in your favor like it did last year. But long term, what we want to look is at fundamentally how are companies doing, and we want to look at balance sheets. We want to look at income statements. Actually, if you interview Warren Buffett, and this is what Warren Buffett says, is he actually spends more time looking at balance sheets than he does looking at income statements. He thinks balance sheets can tell you a lot about a company even before you look at their revenues and their earnings. And so when you look at these companies abroad, you just don't see the strength you see in the top 50 here at home in the U.S. The other thing I would say, too, is because the U.S. is more concentrated as a cap-weighted index, and the Mag 7, like I mentioned, are up 23% versus the general market up 17%, you're starting to see better and better quality at the top. That's why these Mag 7 companies command the market share they do. They didn't get there on accident. They're phenomenal companies. And so should you have everything in the Mag 7? No. You have to have diversification like we do at Stenger Family Office. However, these are very, very good companies, and there's just nothing like them abroad. There's no equivalent of the Mag 7 in China. There's no equivalent of the Mag 7 in Europe. It just doesn't exist. And that's why I've told you the biggest investor still right here. Now, here's what's interesting. Bonds finally had a recovery year. They are negative the past 5 years, but bonds were up. The Barclays aggregate was up 7.5% total return last year in 2025. Finally, a recovery. Gold was up 65% in 2025, if you can believe that. But listen to this. The 5-year return on gold is the same as the S&P 500, the same as large cap US equities. But the 10-year is actually lower on gold than the S&P. And gold's return the past 15 years is still half of that of the S&P 500. So what I think has happened now in 2025, and I think is probably over. I could be wrong. This is a more out there prediction that I would put out there for 2026. Is that I think 2025 was sort of a catch-up trade for a lot of these underperforming assets. So despite all this talk you've heard of how great gold was in 2025, and it was up 65%, it was a catch-up trade because it still trailed the S&P 500 index handedly the past 15 years. So don't feel too bad. Don't beat yourself up for not being in gold and silver and all the rest of it. In fact, Bitcoin was down significantly last year. Ethereum was down. So all of your crypto people actually underperformed you last year just being in the US stock market. So again, when in doubt, zoom out. Don't just look at 1 year in a vacuum. Look at a broader picture. Now, here's a couple of the predictions we made throughout 2025. On December 20th in 2024, this is our market outlook for 2025. We predicted the S&P would reach 6720 by the end of 2025. We actually overshot that a little bit to 68.45, but directionally, we were spot on. We said the market was going to do well, and it did. February 19th, 2025, this is right before tariffs started coming out, and we did a show called Crystal Ball Prediction. You can actually go look this up on YouTube now and watch the show if you'd like. But on February 19th of 2025, we said that the S&P 500 was likely to finish positive, in fact, highly positive for the year. But we would have a correction in the midterm before reaching those all-time highs. Then all of a sudden in April, we had that panic. So again, just like we're telling you for 2026, I think we're going to hit brand new all-time highs in 2026 this year, but not before we have another correction. Maybe not 19% like we did last year, but I do think we're going to have a correction. April 10th, 2025, we said, this is the show, Why I Sold Everything. If you watch the show, you know I didn't actually sell everything. What I did was I sold everything in one of my accounts because it was for a goals-based reason. I had to pay my taxes. And so just like you're on your goals-based plan and you have money for a rainy day and you have money for certain goals that are coming up, same here. I do the same thing with my portfolio. But for my long-term portfolio, for my retirement money, for my money that's 3, 5, 10 years out, I didn't sell anything. In fact, what I did during April was I used that as a buying opportunity. And we told you to buy the S&P when it was 52.70. Everybody said, stay away from stocks. You got to just be in cash and bonds now with all the tariff nonsense going on. And instead, we told you to buy at 52.70. And you are up 31% since then. And you're actually up 38% since the very bottom of the tariff panic in April. So again, stay on your plan. Every single one of these big dips, especially when you go down 20, 30% like that, every single one of them is a correction. I can't tell you how many clients I call during those corrections and I say, you got to buy. And we have a list going of all of our clients who have cash on the sidelines who said, hey, call me when there's a good time to buy. And I go through that list and I call them and I'm like, now's the time. You know, you were waiting for your opportunity. Now's the time to get into the market. And I can't tell you how many of them say, let's wait and see what happens. And that's the biggest mistake you can make. I would say if you see a 5% pullback, get the money to work. If you see a 10% pullback, get the money to work. And you might not be right in a month or 2 months or 3 months, but over the long run, the data points to you being up over time. time. In fact, every one of those pullbacks ever has been a buying opportunity for patient investors. And then finally, September 18th, 2025, this was a show we did called Investing at the Peak. The S&P was at 6,600 points at the time. I had a lot of people saying, Nick, are you sure I should buy the S&P right here? Should I continue to add? And we are still up 3.5% to 4% above that record all-time high. And I showed you the chart where you have people that only buy in the worst days, where it's the S&P is at brand new record all-time highs. So we studied this now. We looked at the data. It turns out that if you only buy at the peaks, you actually outperform people who buy it all other days during the year. And it's kind of fascinating how that works, but that is how it works because there's this momentum factor that happens in the market. So that's 2025. Let me get into 2026 now, and let's talk about some of my points that I think we're going to see happen next year. Well, really this year. Number one, I think the Fed is likely to keep rates roughly where they are for the rest of 2026 with maybe some small fluctuations to the downward side. And I think actually no news from the Fed is good news, meaning if we see massive cuts, that's a bad sign. That means we've entered recession or things are really breaking down in the economy. So I think in 2026, no news from the Fed is likely. We're not going to see massive rate cuts. And I don't think we're going to see rate hikes anymore. I think we're going to be in this neutral zone. That's a very good operating environment for companies, for management teams, and for the rest of the economy. Right now, the effective Fed funds rate is at 3.88%, and the target rate for the Fed is between 3.5% and 3.75%. The Fed only sets that target, that overnight lending rate, and bond markets trade the rest of the yield curve. And so if you look at the 10-year Treasury, for example, that's what a 30-year mortgage is based on. There's a little bit of a spread there. So if you take the 10-year and then you add about a 1.5% to 2% spread above that, that's how you come up with a 30-year mortgage. And that's why mortgages have been a little bit blown out right now. I think mortgages have been overpriced. People just weren't sure what the Fed was going to do. And so I think you're really going to start seeing some easing in mortgage interest rates into 2026. I would guess that mortgages start dropping closer to 5.5%, about a 1% to 1.5% decrease for most people in the market. Some people even got caught up with a 7% mortgage, a 6.8%, 6.5% mortgage. And there are some deals I'm seeing now come out at 5.2, 5.3%. So if you can get a point and a half decrease in rates for mortgages, it's a significant amount of savings for people in the buying market. So if you take a $400,000 average mortgage, which is a little bit higher than the nation average. The nation average is somewhere in the $410,000 home price range. So you would guess a mortgage is typically in the $330,000, $340,000 range. But let's just say in a $400,000 mortgage, most home buyers would end up saving $300 to $400 per month in interest alone just on that decrease in interest rates. That is a massive difference. That's a car payment. That's at least part of a car payment. It's something else. It's a new refrigerator. It's a new dishwasher. And so I think you're going to see the economy start to really take off again, thanks to some of these short-term decreases in rates, especially on the housing side of things. You're going to see refi come back in a big way. That's a good thing for the rest of the market. Median household income. This is a really interesting point. Median household income today is $83,000 for a whole household. 20% of the median home price today is in income is represented. So if you take $83,000 divide by median home price today, it's about 20%. So income to home price value. That seems really high. But if you go back to 1995, it's actually almost about the same. In fact, if you look at a long-term average now, the past 30 years, income to home price on average has been anywhere from 20 to 25%. That's really not that far off of the long-term average. So yes, it's been tough for millennials to find houses just because there's not supply. But if you look at averages across the country, as we get more and more supply, which I think you're going to see more supply introduced to the market as far as home prices are concerned next year. I think we're going to see more home building. I think we're going to see easing of conditions and regulations. And because of that, I think you're actually going to see more and more millennials be able to enter the home market, which is great. Now, a lot of millennials actually have higher incomes than the average across the country. And so if you take an average household income closer to $150,000, you can actually afford more house today on average than you could have 30 years ago. I know this sounds backward. This doesn't fit the narrative that you hear about today, but that is the reality. It's more so a choice of where do you want to live. Obviously, most of us can't go to downtown Manhattan and New York City and pay $1.8 million for a one-bedroom apartment. But there are houses all over the country that aren't $1.8 million that are available. And so I do think that for a lot of millennials, not the entire country, but for a lot of millennials, for a lot of higher earning families, 150,000 isn't really that high of a bar. If you have two people working, one's making 75,000 a year, one's making 75,000 a year as well, that's really not that high of a bar. You should be able to afford a lot of the houses out there. But the problem, and what you hear about, and this is true, is the lowest income tier has been significantly left behind. So if you didn't get past these massive, massive increases in inflation and M2 money supply, remember about a 40 to 45% increase in monetary supply the past 5 years since COVID started, your income is on average down after inflation the past 5 years if you are on the lower end of the income tiers. And so that is terrible. It's sad. It's awful. We want these people to obviously be lifted out of this situation. It's because of a big Fed that we've gotten in this place, gotten to this point in the first place. But I think it's really important to understand that a lot of people have actually left the lower income tiers and they have risen into the upper and the middle income tiers. And so what's actually happened over time is some people would point to the middle class disappearing, but what they fail to mention is there's a different category out there now called the upper middle class that didn't even exist 30 or 40 years ago to the extent it exists today. And these are the families making 150,000. And I've got a lot of families that I run into today that we do financial planning for and wealth management for that are making 180 combined or 200 or 250,000 combined. And they may not feel like they have tons of extra cash flow at the end of the month, but they're doing okay. They are buying cars. They are buying homes. They're spending money. They're out in the economy. They're maybe taking a trip every year with their family. And there is a whole segment of people out there called the upper middle class now, and they are doing quite well. And so, yes, the bottom tier is struggling. We want these people to do better. I think a lot of the technology that's coming is going to help with that, and it's going to bring real wages up, just like technology has always done. But in the midterm, you are seeing the upper middle class really rise forward, and that's a very positive sign for the economy in 2026. The next point that I think is going to happen in 2026 is you're going to see the inflation rate start to slow. It's already slowed in 2025, but I think you're going to see more moderate inflation in 2026. In fact, CPI now is only up about 2.5% the past 12 months. Remember, as consumers, we think about the price level of goods, not price increase of goods. And so while everything is up and it seems more expensive today than it was 5 years ago, and that's all true, the rate at which it's going up now is much, much more slow. We're rising a lot more slowly than we were 2 or 3 years ago. So that rate of inflation is slowed down to 2.5%. That's a very good thing. The long-term average of inflation is 3.7%. But over the past 10, 15 years coming out of 08 and 09, we're actually trending back towards these much lower rates of inflation. Coming out of 08 and 09, we were sitting about 1.5 to 1.8%, which is essentially non-existent inflation. And today we're trending back towards that. That's a very good thing. And you're seeing this now just practically as you look at some of the places you may go to, like McDonald's. McDonald's is finally bringing back now these extra value meals. You're seeing a lot of places run sales. I'm seeing car manufacturers run 0% financing deals. That means they need to move inventory. So this is a good thing. You're going to see deals come back. You're going to see prices moderate. And that is a positive sign for the economy again this year in 2026. And you also have already seen this now with home prices. Home prices are down 7.2% since their peak. We are not in the crazy environment that we had during COVID. Yes, supply is tight in the north, but in the south, where we've had a lot of extra building, probably more than we needed, home building has actually gone a little bit too fast, faster than even demand would be. So we have a little bit of a supply glut in Florida and Texas and some other places in the country. And so that is helping these home prices come down. So not only do you have interest rates coming down a little bit, but I think you're going to have inflation coming down and you're already seeing prices come down. This is freeing up cash in people's budgets to be able to afford more and make their budgets go a little bit farther in the new year. Now, here's my last point, and I just want to point out something about this $150,000 median income. This is obviously not the nationwide median. The nationwide median income is closer to about 83,000. But again, I see a lot of people in this 150 to 200, 250,000 a year space. And I just want to point out for a family that's making $150,000 combined as a household, they are paying roughly $16,000 a year in federal income tax. They're also paying around $11,000 a year in employment tax. And this is what's really important to understand is that employment tax, the way that things have happened since the Great Depression and FDR's time and the Great Society and all the follow-on social spending programs that we've implemented in the United States, is we actually give almost as much to the federal budget as we give to social programs. And so a family making $150,000 combined is paying only $5,000 less in employment tax than they're paying in federal income tax. Most of your federal income tax is now going to paying the debt off and really not even paying the debt off, but paying the interest payments on our national debt and then defense spending. But you're also paying $11,000 as this married couple at $150,000 of income towards social programs. So by the way, that's only half of the Social Security and the Medicare tax. Remember, your employer actually pays the same amount. You pay 6.2% for Social Security and 1.45% for Medicare, but so does your employer. So if you double that tax, a married couple at $150,000 a year of income is actually contributing $22,000 per year to social programs. And so that is higher than the amount that you would contribute towards the federal income tax burden. So here's what's really interesting. If you take that $22,000 and you compound that over a 30-year career, you would have a portfolio roughly at an 8% interest rate of $2.5 million after 30 years. So let's just say you started making as a married couple about 150 grand a year at age 30, and you wanted to retire at 60. At age 60, you'd have $2.53 million set aside. On that $2.5 million, on a normal financial plan like our firm would put together, you would have roughly $10,500 per month that you could spend on that $2.5 million portfolio before tax. $10,500 per month. And by the time you got to age 90, you'd still have about $2.5 million left over. Here's how Social Security works instead. You're going to contribute that $22,000 between you and your employer every single year for 30 years. You're going to wake up at age 60. You're not even going to be eligible until Social Security until 62, where it's reduced. And best case scenario, you're looking at maybe $4,000 to $5,000 combined per month as a married couple. So you ask yourself the question, where is all that extra money going to? Well, it's all going to this thing called transfer payments. It's going towards social spending. And it doesn't hit the upper class, the top 1%, the top 10% of people, the same way it hits people in the middle. People in the middle making 150, 200, 250,000 as a combined income per year pay the brunt of the taxes in our country. And I'm going to go through a couple numbers with you here, but let's go back to the beginning of my example. Let's say you're this married couple. You're paying $16,000 a year in federal tax. You're paying about $11,000 on your side for employment tax, plus the employer of another $11,000, which reduces how much you get to take home anyways. Let's say you're in a state like Illinois, even Texas, while they don't have a state income tax, you have state and local and higher insurance costs and all the rest of it. Let's say you're paying another $10,000 a year in state and local tax. You have about $37,000 a year out of just your pocket going towards tax, about 25% of your income per year. So the reason that inflation is high, the reason that you feel like you don't have as much money left over at the end of the month to spend, it's not because corporations have gotten so greedy. In fact, profit margins on the S&P have gone up a little bit, but it's really been driven by tech. It's not been driven by grocery stores. It's not price gouging at the pump, for example. It's really a big government. And I think this is important to understand. Big government is the problem and the reason why inflation is so high. In fact, interest payments alone on our debt, if you look at the data now, are 1.2 trillion, not billion, trillion dollars per year, which equates to another tax. Remember, money printing, our debt payments are another hidden tax. It equates to another $9,000 per US household per year, which is another 11% per year in tax. So not only are you paying 25% directly, plus your employer is paying another 11,000 on top of your 150. So when we add all these taxes up, plus the debt payments, about 43% of your income goes towards paying down our debt, which again, like I said, isn't really even paying down our debt. It's just servicing the debt, the $1.2 trillion in interest, plus the taxes, plus the employment taxes and everything else that goes into it. A couple making $150,000 combined, which is not a top 1% salary, and it certainly doesn't make you a billionaire or a multi-millionaire, is paying 43% per year in actual real taxes. That's the problem. And so there's no way that you can possibly get this under control by opening up more social programs or having a universal basic income. These are not the answers to the problems we have. In fact, these are the problems themselves. The only answer to these problems is to shrink the size of government, to shrink our spending, and to get this budget under control. Because again, this doesn't just affect people like you see in New York City with Mamdani, who's talking about $2, $3, $4, $5 million a year families. We're talking about the middle of America. We're talking about $100, $150, $200,000 families, and that's a lot of our clients, quite frankly. So when you see these numbers, really think through this when you go vote. We're going into midterms next year. Really think about this, and again, like I tell you every election season, vote with your wallet because the hidden tax is incredible. If you're this family making 150 grand, remember, you've got about 43% of your money just going to debt service and tax payments. Now, what's really, really interesting, and this is a unique phenomenon at this point in U.S. history, is that not only do you have this debt service and all these taxes, but if you look at total transfer payments in the U.S. now, it equates to $37,000 a year per household that we pay out in transfer payments, entitlement programs. That is the reason we have the inflation that we've had. That's why we have the spending that we have today. That's why we have the debt service that we have today, is because of these massive transfer payments. Nearly half of your income today goes to taxes and inflation, which is a hidden tax. So despite that being a major headwind, and it's been a headwind in 25 and 24 and 23, all great years in the stock market, the answer to all this inflation, to all these taxes, to all of the issues we've seen and that we face is growth. And thankfully, the saving grace of the U.S. economy for the past 200 years, and I think in 2026 will remain true, is technology. It's been entrepreneurs. Right now, here's the math of the market. The S&P 500 is trading at 25 times current earnings, but we don't care about current profits. We care about future profits. We care about 2026, 2027 profits. So today the S&P is actually trading for a pretty reasonable 21 price to earnings ratio on a go forward basis, which is not radically different than where it's been the past 5 years. But if you go off of 2027 profits, which we will trade on at the end of 2026, you can buy the S&P today at about 18.5 to 19 times forward earnings for 2027 numbers, which is absolutely incredible. Does it make it the cheapest the S&P's ever been? No. Does it make it as cheap as it was in 08 and 09 or 11 or 13 when we had some larger corrections? Of course not. But I believe the S&P today is trading for a very reasonable price. And actually, if you have what analysts expect to be about a 16% increase in earnings in 2026, I think the S&P can easily support 7,500 to 8,000 points, with some places putting the S&P north of 8,000. I think if we get north of 8,000 into the 9,000 range, we are going to be in bubble territory. I don't expect that, but easily off of earnings growth in 2026 and 2027, you can support the S&P trading at 7,500 to 8,000 without any valuation expansion. So all of the people saying that this is the late 90s or that we're in a bubble and the market's going to come crashing down any second are just wrong. They're just not looking at the math of the market. If we trade the S&P at my price target of 77.20, like I shared with you last week, That's a 12.5% increase from today's price. It's not a 20% return like we had for the past couple of years now. So don't get used to 20%. Don't base your financial plan on it. But it's not Armageddon. It's slow and steady growth, just like we expect. In fact, we build our financial plans for clients anywhere from 7 to 8% returns. If you're a little bit older, we use 6.5. If you're a little bit younger, we might use 8. But it's not Armageddon. It's not like the sky is falling. I think we are going to see pretty good growth in 2026. So that's the setup for 2026. I've been calling it a pretty good setup, not a perfect setup, not a Goldilocks setup, not a fantasy market where we're going to go up 30% or anything like that. But I do think we have a very good setup with moderating inflation, increasing consumer confidence. I think industrials are just at the beginning of their renaissance. I think we've got a wonderful setup. We'll call it pretty good for 2026, where you're going to continue to see this thing called sector rotation. And remember, sector rotation, like I've told you in the past, is the lifeblood of the bull market. What is sector rotation? Sector rotation is not just 7 companies leading, not just 7 stocks that are producing all the returns, but other companies like financials and industrials and consumer discretionary also leading as well. And so when you saw the S&P go up 17% in 2025, you have to remember energy stocks were up 8.5%, financials were up 15%, healthcare was up 15%, industrials were up 20%, and materials were up 11%. So it's not just 7 stocks leading the market. In fact, the equal weight S&P, which is just every single company in the S&P 500 at the same exact level, the same exact weight, is at record all-time highs. So the people telling you it's just 7 stocks leading the charge are wrong. They're not looking at the data. And so when you see market breadth like this, and I think we're going to have continued market breadth into 2026, that's a very positive sign for a continued bull market. Now, one other prediction I'll make for 2026 is AI is going to be good this year. It's not going to deliver quite as much as people think. It never does. We estimate what technology is going to do in the short run and underestimate what it's going to do in the long run. But new technology that's being driven by the backbone of AI, which in a lot of cases is machine learning, which has been around forever. It's high-speed computing, which has gotten better and better and better every single quarter of every single year. It's cloud computing, which is just at the early edges of doing wonderful things for Fortune 500 earnings, will drive the market forward in 2026. So while you may see some moderating talk of AI, a lot of the technology behind AI is real, and it's just starting to get used at S&P 500 and Fortune 500 companies. So you should be excited about what profits are going to do next year. I still go to certain places like car rental places, and you deal with airlines sometimes, and you can't believe they're making you fill out forms on paper still. Well, they need to get on the cloud, and you interact sometimes with healthcare companies, and they're still using paper and spreadsheets and all the rest of it, and they're not on the cloud. And so there are basic things that are coming this year, I believe, that are going to continue to power the S&P forward, despite AI maybe losing some of its buzz. Now, last thing I'm going to share with you for 2026 is this correction that I think is coming, how it will actually work. And it may not hit these numbers exactly, but this is how a general correction will function. Just like in 2025, the market opened the year last year at around 5,900 points. It went up 4% to 6,150, but then corrected down 19% to 4,900 points. After it hit 4,900 in that range, 4,900, 4,950, it ripped off those lows, like I said, about 38% back to brand new all-time highs in the 6,900 point zone. That's how corrections work. So you'll see this steady increase going up. Everything looks good. Then a big drop. And you see that valley. And when you see those waterfall corrections, they're typically followed by waterfall recoveries and V-shaped recoveries. And so that's what I think is going to happen again in 2026. I think we're going to have this steady trajectory from 6,850 back to 7,000 points, maybe 7,100, 7,200, which would be a 3 to 5% increase, depending on where we end up. Everyone's going to be thinking things are great, and everybody who sat out of the market is going to buy in at the all-time high at 7,200. And then we're going to have some sort of news that breaks, and it's going to cause us to have a correction of about 15%. That's my guess. I don't know exactly, obviously, back to the 6,000 point level, just like we had in 2025, but to the 5,000 point level. And that's when I think we're going to rip off those lows, have a V-shaped recovery again, that pushes the S&P back to 7,700 points. So should you try and time this thing out? No, because I could be wrong. I could be wrong in the timing and how everything works. But the better thing would be to buy the S&P around 6850 where it's at today. Throw your money in your 401k like I am. I've got my 401k, like I said, maxed out around 82% to try and get the money in there quickly this year. And then just ride it out for the rest of the year. And just prepare yourself mentally. We're going to have a pullback. We're going to have a correction. You know it's coming. But when we get past it, you're going to be very happy you just stuck to your goals-based plan. So that's my outlook for 2026. Again, thank you for being on for the very first episode of the year. I hope you and your family have a prosperous and wonderful new year. And we'll see you next episode, 211, next week.